Life insurance proceeds are income tax free. In this episode, I'm going to address the question, do you pay taxes on life insurance proceeds? Well, the simple answer is no, but it's way more than that. Get ready to be blown away. My name's Doug Andrew. I've been a financial strategist, a retirement planning specialist for more than 4.5 decades. Clear back in 1974 when I started, I actually got my Series 1 securities license. They don't even offer that anymore. I could sell any stock, bond, mutual fund in America, okay? But I also got my insurance license. And so I've helped many people obtain life insurance, not only in the event that they die with an untimely death, which is being responsible and accountable, but also maximum funding insurance for living benefits, because most people live a long time. And the beauty of an insurance policy is not only that when you ultimately pass away, life insurance death benefit proceeds are totally income tax free, but money that builds up inside of the insurance policy is tax free. But unfortunately, a lot of people think, well, insurance is for death. It's not for accumulating money. And I'm going, what? Hello, it's tax free. E.F. Hutton back in 1980 realized this, and they said, my heavens, it's tax free. Instead of taking the amount of insurance you want and trying to shop for the cheapest premium that you can find, they said, why don't we take the least amount of insurance we can get away with and put in the most premium the IRS allows, and it will accumulate tax-free into this cash cow. And this is where I have earned rates of return of 7 to 10% for the last 40 years, tax-free. That's better than any IRA or 401k that is only tax deferred. See, an IRA or 401k has to earn 15% to net 10. My insurance contracts for 25 years have earned 10. They net 10 tax-free. And it's much more stable than an IRA or 401k in the market to try to earn 15 and then net 10 after paying tax at the end of the day. But let me share with you 3 sections of the Internal Revenue Code that make a life insurance contract a sacred tax-free cash cow. So before I share with you 3 sections of the Internal Revenue Code that protect life insurance contracts from being taxed, let me share with you how you can learn even more about this topic and others. Hit subscribe. Share this video with people who also are wondering the same thing, because I'm passionate about educating people like you. Back in 2005, I let all my professional licenses go to become a consumer advocate. So I'm into educating you. And at the end of this episode, I'm going to show you how you can claim a free copy of my most recent best-selling 300-page book, The Laser Fund, which is a maximum funded tax-advantaged life insurance contract that most people use for living benefits, for retirement, for college funding for their kids, for working capital for business, and on and on and on. But when they ultimately pass away, anything in the insurance policy blossoms, increases in value, and transfers income tax-free. If I were to die tomorrow, I'm 68. If I died in an accident, right now, every million in my portfolio of insurance policies would blossom to about 2.5 million, totally tax-free. Why? That's been a sacred cow in the Internal Revenue Code for as long as the code has been around, 1913, okay? Why? Why does the government do that? Because they realize that if they taxed life insurance, why do people buy life insurance? Usually so that if they passed away, it provides the means, an immediate estate that will take care of people, provide college educations for your kids, your grandkids, or pay off the house or whatever had you stayed around. Why would the government penalize people for trying to be self-reliant? Because they've done studies and found out if they taxed it, they would be shooting themselves in the foot. In other words, if they tax those, then those people a few years later, widows and orphans, would be coming around for government help, for welfare. And so why do that? So far it's been this sacred cow. Leave it alone. Well, as far as the money that grows inside of an insurance policy, those are called cash values. Now, a lot of times people think, well, why should I pay more than I need to be insured the rest of my life? Because it's tax-free. E.F. Hutton, who was not an insurance company, they were a brokerage firm. They realized a lot of people had their money in the market in stocks, and it was like a person with a yo-yo, hopefully walking up some stairs. But I don't know if you have ever played red light, green light. See, as a kid playing red light, green light, there are sometimes I might advance 20 steps and then take back 10 steps. People with money in the market, some periods you might make 20%, and then the next period you lose 10. You're going back and forth, back and forth. E.F. Hutton said, why are we doing this? Especially if we averaged even 12%, which most people don't do, on $1 million. If you were going to average 12% rates of return, that would be $120,000 a year. And they realized you pull out $120,000 out of $1 million nest egg, you're going to pay tax of about $40,000 between federal and state tax. You're only netting $80,000. And then you have another 1% in fees, so you're only netting $70,000. You have to earn $120,000 to net $70,000 to buy gas and groceries. They said, why are we doing that? Back at that time, it was 1980. Why don't we take 11 steps forward and only 1 step back and net 10% tax free? In other words, most insurance companies on their general account portfolios were earning between 11.75% and 15.5%. I never earned less than 11.75% from 1980 to 1990. So with that metaphor, I was taking 11 steps forward, 1 step back. What's the 1 step back? It's not tax. It's the cost of the insurance that the IRS says has to be there, or it's not going to be tax-free in the code. The Internal Revenue Code says money inside of an insurance policy grows tax-free. That's Section 72E. When you go to access money, if I have $1 million in there, I can pull out $900,000. I could pull out $100,000 a year for retirement. It's tax-free. That's Section 7702. And when I ultimately die, anything left in there blossoms, increases in value, and transfers totally income tax-free, Section 101A. It's totally tax-free, a maximum funded insurance contract, what I call the LASER fund. LASER is an acronym that stands for Liquid Assets Safely Earning Returns, is the only financial instrument that allows you to accumulate your money tax-free, Section 72E. Access your money tax-free, Section 7702. And when you die, it blossoms, increases in value, and transfers income tax-free, Section 101A. Show me anything else that does that. A Roth does not do that. And so this is my favorite vehicle for all kinds of goals, because you do not pay tax on insurance proceeds, which is what this episode is about. But hello, you don't pay any tax as it's growing either. So this would be like an IRA or 401k on steroids. But when you die, nobody pays tax. It blossoms. It'd be like an IRA or 401k that has $1 million in it. When you die, it automatically turns into $2.5 million and transfers income tax free. Your spouse, your kids don't have to pay tax. There's not an IRA or 401k around that will do that, but the LASER fund will. Why not employ a LASER fund? It is way better than an IRA or 401k, especially with the same amount of money. It will give you sometimes double to triple the net spendable income during retirement. But when you finally pass away, it blossoms and transfers tax-free. I'm going to share one last little aha epiphany here, and then I am going to show you how you can claim a free copy of my most recent best-selling book. Don't look at what it is, look at what it does. If I put money into an insurance policy and I maximum fund it under IRS guidelines, it turns into this tax-free cash cow. Well, I use that for retirement because it way outperforms IRAs and 401ks or even Roths. Roths have 2 benefits. You take after-tax money and put it in there. It accumulates tax-free. When you take it out, it's tax-free. The LASER fund does that. It's been grandfathered for over 100 years. But I can put in huge deposits. 200, 300,000. You can't do that into a Roth. I don't have to. I can put in 30,000. But if I could have put in 300, I can put in the other 270,000 anytime I want in the future. You can't do that with a Roth. See, People who make too much money can't own a Roth. So sometimes savvy CPAs and tax attorneys call the laser fund the rich man's Roth. And I snicker because you don't have to be rich to own one. You can set one up for $500 a month if you want. But see, I can put in large lump sums. I can make up for years. But if I put in $300,000 one year because I have a banner year and I need $250,000 back in 30 days, I can do that. There's no penalties. With a Roth, you have to wait 5 years or till you're 59 and a half. Who wants all those strings attached? I can link my returns so that when the market goes up, I make money, but when the market goes down, I don't lose, because money inside of an indexed universal life contract is not actually at risk in the market. You participate when the market goes up, but you do not lose when it goes down. And you need to learn about that strategy because it's a game changer. But at the end of the day, when I finally pass away, it blossoms and transfers tax-free. So let me give you a few teasers, and you may want to search on this channel for some related videos about this. I not only use it for my retirement, but I have owned life insurance on my father. I couldn't on my mother. She had already had some heart attacks early in life. She was uninsurable. My father-in-law, my mother-in-law, and when they all passed away, I got a huge lump sum of tax-free capital. The rate of return was far better than if I had been putting those premium dollars into the best investment account you could ever show me. Likewise, my children own insurance on me. If they put money in an IRA or 401k, I would go crazy. What are you thinking? If they put $1,000 a month into $1 million policy on me, and if I live a long time, they're going to have an incredible tax-free rate of return that is better than any IRA or 401k would produce. But when I die, they have an automatic $1 million tax-free that they know they put it into a new insurance contract on them, and it will generate $100,000 a year of tax-free income. They would have to have an IRA or 401k that produces $150,000. You pay tax to net the same 100. Hello? Are you getting some epiphanies? Every person in our family, when they pass away, we take 20% of that insurance benefit tax-free and we fund the next insurance policy on the next oldest, healthiest family member. And our family bank is funded into perpetuity. We will never run out of money and we keep it tax-free. I've written 11 books. I want to show you how you can claim your free copy to learn more about what I call the Laser Fund. So my 11th book, we're in our 6th printing. It's been flying off the warehouse shelves. It's called the Laser Fund. It's actually 2 books in one. At this side is 200 pages, 14 chapters, all kinds of charts and graphs. This side is the right brain side, about 100 pages, 12 chapters with 62 chicken soup for the financial soul stories. You can read both books if you'd like. It retails for $20, but I want to gift you a free copy. Go to Laser Fund, L-A-S-E-R, laserfund.com. Contribute a nominal amount towards the shipping and handling, and I'll cover the rest of those costs, and I'll pay for the book and fire it out to you. There's other options in there to learn, listen and learn, watch and learn, and be sure and search this channel and subscribe, and you'll be notified every time I post a new educational video, which is almost daily, to empower you so you can become financially independent.